So you're thinking about using infinite banking. What about these interest rates? What are they? What do they look like? How does it work for you? Let's talk about that now. All right, so what about these infinite banking interest rates? We always talk about using infinite banking for leveraging for interest rates and leveraging loans and things like that. But what are they? How big are they? How small? Should we be using that? I want to discuss that in this video today. All right, so let's talk about these infinite banking interest rates right off the bat because I want to answer your question for those of you that got like ADHD, you can't even focus for like 2 seconds, all right? What are the interest rates? It depends on the company and it depends on the time. So interest rates tend to follow whatever the dividend rates do. So the dividend rates are the interest that you earn on those policies. So as dividend rates go up, interest rates, the loan interest rates will also go up. But if they also go down, they will also go down. It's kind of just correlated that way. So the real question people will then ask is, and you're probably asking yourself is, well, what determines the dividend rates? Well, the dividend rates are all based on what interest rates are doing. It's based on the performance of the company, presuming it's a mutual company. If it's a stock-based company like MetLife, it doesn't really matter as much. But when it's a company that's making more profit and you see interest rates go up like we've seen over the last couple of years, you tend to see the dividend rates go up as well. Why? Because life insurance companies will invest in things like treasuries and bonds and things like that. So good news for you, if you have an infinite banking policy or a whole life insurance specifically, good news for you, rates are going up. Now, if you have universal life, that could also be good, but not if you have variable universal life or index universal life, because as rates go up, there tends to be another relationship of the markets going down. They don't like to go up as much when interest rates go up. They love low interest rates. That's why we saw such amazing growth like after 2020, right? But that's not happening right now. Now we're starting to see things they're still going up, but you're wondering if it's running out of steam. So just be aware, when I'm talking about interest rates, specifically I'm talking about whole life insurance interest rates, right? Those that are tied to dividends. And those interest rates are going up. Now, like I said, it's all based on the dividends. Right now, I'm talking about in 2025. If you're watching this in 2027, this could be a totally different story. But right now in 2025, the dividend rates you're seeing with most insurance companies are starting to get up around 6% or more. What's interesting, by the way, is that this is actually predicted to be higher than the stock market over the next 10 years. Vanguard actually predicts the stock market will only do about 2.8 to 4.8% in the next 10 years, which means the safer, more secure option, whole life, is going to be up higher. This is also why interest rates have stayed higher too, because of that very reason. People are rushing their money into safer places because they don't trust the stock market anymore because it's been too hot for too long. So as a result, you're seeing these dividend rates go up. This also does mean the loan rates are higher, but they're not as high as what you might get through a bank. For example, if you're trying to get a credit card right now, it's not uncommon to see credit card rates over 13, maybe 18, 20% right now. The average is over 20% currently. Well, right now, the loan rate for life insurance is usually around 5 or 6% currently. Much better. So a lot of people are starting to see this pattern saying, this may not be a bad time to use this money. Much better than trying to use a credit card. Well, even looking at car loans, some car loans are around 7 or 8% depending on what you can get right now. Some are even as high as 9% or so. Could using this be better than getting a car loan? Possibly, right? Mortgages. Now mortgages, I think they're still okay. I would still get a bank mortgage. And that's one thing I like to do too. When I'm using this, just as a bonus for you guys in this video here, when I'm looking to use these life insurance policies and leverage the loan aspect, the thing is, I'm also looking at, can I get money from the bank? Because I don't want to use my own money. Because let's be honest, when you're talking about infinite banking, there's all these infinite bankers out there telling you all this crap, right? They're kind of doing these half lies, half truths to you. They'll say things like, you're paying yourself back interest. BS. It's not true. You're not paying yourself back interest. The insurance company is literally charging you interest on your loan that you get from them. Because when you borrow money, you're not borrowing from yourself. You borrow from the insurance company. Your money's still there. The reason they say you pay yourself back is because they're saying, why don't you take that money you're borrowing and then pay back at least interest only, if not principal and interest back, so the interest doesn't compound against you. Now, doing that is a good thing because in the other side, because you didn't access your money's still over here earning tax-free compounding interest. So if you're earning even the same dividend rate or right about the same dividend rate while you're paying the same rate, if you keep paying that loan down, less and less gets charged in interest while they're paying you more and more of compounding interest, and you make a spread, you make more money. That's why they say that. They say pay yourself back, but again, you're not really paying yourself back per se. You're just paying down that line of credit with the insurance company that frees up extra cash over here that you can use again. So just be aware, just be careful, because those little subtle things they say to try to sell you on this, it's not the same. It's definitely not the same, and it can actually cause you to not trust it, when in reality, the truth, in my opinion, is better than what they're teaching over here. So remember that loan rates can go up or down, but it tends to follow the dividend rates that are going on. What's interesting though, just in the last year, 2024, did you know that the interest rates were actually higher on the loan rates? So it was fascinating. We saw all these companies move their loan rates higher, but then all of a sudden moving to 2025, I watched them drop again. But they did not drop the dividend rates. So they left the dividend rates higher while they dropped the loan rates. This is good for you once more, because if the loan rates are lower, the dividends are higher, you're making more money on that money than what you're paying when you borrow this money. So this could be really becoming this better period than it was the last few years when the rates went up and everything else. Now it's becoming a better period to actually leverage and use this money. But once again, when I use this money, if I can get bank money, I can use the bank's money instead of my own money, I will do that all day long, especially if it's a low interest. So I'm gonna borrow money from the bank to buy that car. I'm not gonna use this money over here from my life insurance. I'm gonna borrow it from the bank. I'm gonna borrow money to buy that house and everything else. But the money that I can't borrow from the bank, that's when I use my life insurance. Why do we do that? Because that's what investors do. See, understand that all these infinite banker guys, these insurance agents that don't know jack squat about investing money, and they don't know how to make money unless they sell you insurance, right? That's the only way they make money. Understand that I'm coming from an investor standpoint. I am financially free before I even worried about doing this infinite banking stuff. And I will tell you this, is that I, from an investor standpoint, want to leverage the bank's money as much as I can, so then I've got my money to go and make more money with it. So for example, if I want to buy a rental property, I'm going to get that 80% or 75% mortgage from the bank and only use my 20 or 25% using the money from my life insurance as the down payment, rather than trying to pull all of it out to pay 100% on that house. I want to leverage it because now I can buy 5 homes with that 20% down payment versus just 1. That's the difference. I can grow my money much faster doing it that way. Now, that's not the point of this video. The point was about the interest rates, right? What are they right now? Right now between 5 and 6%. But I'll say this, if you want to learn more about what else you could be doing with this, how can you make more money and really take advantage of these interest rates that they do charge you on this life insurance, go watch our other videos, subscribe on our YouTube channel today.